and then why they believe this to be ineffective. We have with us Alastair Sewel, Senior Director and Head of Fund and Asset Manager Ratings for Asia-Pacific and EMEA with Fitch Ratings. Alastair, thank you so much for joining us today. Let's just first up understand, why do you believe that the RBI's action, that 50,000 crore rupee liquidity facility, will be ineffective in sort of supporting the mutual fund industry?
Thank you very much for having me on, Mobina. It's a pleasure to be here. The RBI facility is relatively small compared with the total size of the Indian mutual fund sector. So in the first instance, there is a gap between the size of the facility and the overall size of the market, although it is important to say that not all funds will experience the same issues that we saw with the Franklin funds. Perhaps more importantly, however, and this is our core view, is that the effectiveness of the RBI facility may be limited because it will implies some credit risk transfer to the banks. If you compare that with other facilities in support of mutual funds we've seen in other parts of the world, and in particular with the money market mutual fund liquidity facility in the United States, there is no recourse to the borrower. So there is a material difference in the terms and conditions of this facility in India compared with facilities in support of mutual funds we've seen in other markets around the world.
Okay. Now, Alastair, I think it's also one could also blame the banks, I suppose, because they have been extremely reluctant in taking on board the relatively higher risk assets. They have been extremely risk averse. They seem to be unwilling to absorb any sort of, credit risk or capital risk. And you as well, I think you as well have mentioned that, I think in your report, that the success of this facility will depend on the bank's appetite to take up the risks involved. There was that targeted lending repo operation, long-term repo operation that was undertaken by the RBI. It barely saw any demand. This time around as well with this 50,000 crore rupees. Of course, size is one thing. You believe, of course, that the Indian MF industry is extremely big, but don't you think it's also the whole reluctance of banks to take on any sort of risk that would also lead to this operation turning to be ineffective?
Yeah, absolutely. There is a key sensitivity here, which is the transmission mechanism. So the way that this facility in India, as much as the facilities in other markets around the world, the way that these facilities and the effectiveness of these facilities in transferring the support through to the end recipients of the support, in this case to the mutual fund sector. And really the linchpin, the critical point here is the banks, and is the willingness of the banks to on-lend or increase their exposure to the mutual fund sector with this facility. Now, if that doesn't happen, and this is one of the key risks that we point to in our research note, we believe that more mutual funds could be at risk. There have been significant outflows from some categories of funds over the recent weeks in India, and furthermore, we have seen multiple instances of valuation issues, which makes some assets tricky to value. This combination of valuation issues in mutual funds combined with outflows is an extremely challenging combination for funds, and can lead to funds suspending redemptions. So it is critical here to the effectiveness of this program, of this support facility for mutual funds, is how that money from the facility actually gets through to the end recipients, to the mutual funds themselves.
Alastair, which funds do you think would be most vulnerable to this whole this whole outflow risk and this redemption risk? You mentioned that, if in case this doesn't go through, many more mutual funds could suffer the same fate as the Franklin one did. But which category? I mean, I would hazard a guess in saying that credit risk funds perhaps would be most vulnerable.
So it's going to be very dependent on the particular asset class and the particular strategy of the fund. It's important to state that we, Fitch Ratings, don't rate any of the funds which have gated, and nor do we have any ratings with Fitch Ratings on any of the credit risk funds. What we see time and time again in the cases of mutual funds suspending redemptions or gating is that there is something particular about the investment strategy that makes that fund particularly vulnerable. The usual culprits are exposure to less liquid securities, and these can be from a range of different reasons. There can be very low credit quality securities can prove illiquid. Securities which are unlisted are, by definition, less liquid than listed securities. So it's these idiosyncrasies. It's the exposure to lower quality assets. It's the exposure to unlisted assets. It's exposed to assets which are less liquid, period, that are more likely to trigger funds to impose these extraordinary liquidity management measures like suspending redemptions. Credit risk funds saw outflows of approximately 10% in March of this year. So there has been redemption pressure in that sector, and we do know that these funds are, by definition, going to be exposed to riskier securities and potentially to less liquid securities. So this sector does appear to be at relatively higher risk than some other mutual fund sectors.
All right. Alastair, clearly those companies that are not AAA rated companies, the securities of those companies, nobody seems to be willing to invest in them. Banks are not willing to invest in them. They don't even want to give it to mutual funds that have these as underlyings. What is then the outlook for such companies and organizations? And also, in light of this, what could even the RBI do, since transmission is such a problem?
So the key issues that we've seen around the world as this COVID-19 pandemic has spread have very immediately been driven by liquidity and by valuation concerns. And by liquidity, I mean secondary market liquidity, so the ability to buy or sell securities to other market participants, rather than the funding liquidity. And the key issue here is that where companies have any issues or where the investor perception turns against them, this can affect the market liquidity of these, and that can affect the ability of mutual funds to buy or sell these securities. And as that liquidity, that market liquidity in these securities declines, that raises valuation problems for the funds, and it also raises acute problems where the funds start seeing significant outflow activity. You can get a vicious cycle of redemptions leading to valuation issues, leading to further redemptions. So it's managing the exposure to those less liquid securities is a key challenge for the mutual funds as participants in the market. In terms of what the RBI can do, I think it'll be incumbent on the RBI to look at the effectiveness of the facility and the effectiveness of the transmission of the facility to the end recipients, to the mutual funds themselves.
All right. Alastair, thank you so much for joining us with highlights of that report.